Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Drew Meredith, welcome to this episode of the Australian Investors Podcast.
Thank you. Excited for another reporting season.
Yeah, reporting season, August 2022. We did this a couple of reporting seasons ago. It's heaps of fun. It's when all the companies release results, all Australian companies. And we've got some US companies today because the first week was a bit quiet. If you're watching, this episode is unofficially sponsored by San Pellegrino Sparkling Water.
They're probably owned by Coca-Cola, aren't they?
I don't know. It says it's still it's just brewed in San Pellegrino in Italy. So it's a proper place. I think Monique, our producer, you're going there in a few months. Yeah. Okay, great. Anyway, back to the podcast. So today we're talking about 10 companies. We're going to do, hopefully, if we can manage it, 10 companies every week in a bit of a reporting season blitz. There are, numerous reporting season calendars you can get a hold of. I've got one from ComSec in front of me, which I think, as usual, would reference Bloomberg estimates. Yep. And over the last week, we've had Australian Foundation Investment Company, Rio, Credit Corp, Pinnacle, BWP Trust, Genworth, Centuria, Block, and we'll get to some other small caps that have released quarterlies. Next week, we've got companies like Horizon, Suns Corp, REA, Megaport, CommBank, ResMed, heaps of companies next week, so there'll be plenty for us to choose from. If you do want us to cover particular companies, if you are interested or hold companies that are reporting, please write into us. It's podcast@rask.com.au. You can also find us on the Waddle Partners website. Links are in the show notes, or on Twitter or LinkedIn. Just send us a message and we'll try and cover the company that you're interested in. I've already had one come through for Horizon, which is not a company that I follow that well. So
me either, so it'll be interesting to take a closer look at it.
Yeah, cool. So maybe just a quick jargon buster. When we talk about estimates, we're typically talking about analyst estimates. You can get them through Bloomberg, Refinitiv, if you use the ticker terminal, SelfWealth, any of those platforms will have it. So that's what we're talking about when we talk about estimates, and we're probably going to see a lot of volatility this reporting season. We're going to see a lot of companies rise or fall.
And it's worth considering that when stocks fall by 5, 10, 15%, it's not necessarily, even a lot of them report profits and then fall by 15%, but it's due to the fact that they're lower or higher than what the analysts were expecting.
Yeah, so we'll probably quote a bit of that as we go through. So just keep in mind that analyst estimates can be wrong. And if you're a long-term investor, I think the correct way to frame it isn't the company failed to meet analyst estimates. It's actually just the analyst got it wrong. So that's the company delivered what it delivered.
Hopefully there's no analysts listening.
Yeah, hopefully. I think 5% of our audience identify as professional investors. So there may be a few. Sorry if you're listening. Okay. And we're talking about sell-side analysts. They're doing something else right now. They're not listening to the podcast. Okay. So maybe we'll go I go, you go, or you go, I go. What do you want to do? Do you want to go first or?
You go, I go.
Okay, sweet. So the first company out of the gates is Alcydian. A couple of companies that, by the way, that I'm covering are small caps and have reported quarterly updates for cash flow, not their full year results. So keep that in mind. And they reported a bit earlier. I'm just covering them because they're interesting and I know our audience will want to know. First one is Alcydian. It's a medical technology company. Basically, it helps hospitals and outpatients and nurses and doctors manage patient flow in hospitals. So it's a clinical decision support system, or CDSS or something like that. And basically, they sell their software on subscription. The software goes into hospitals and like clinics and respite and all that. And it can be used to monitor patients, check vitals, all that sort of thing. So the company is pushing subscription revenue really hard. They want as much recurring revenue as possible under the CEO, Kate Quirk.
US or Australia?
It's Aussie, ASX ticker symbol ALC. It's a small cap. For 200 million would be a bullish estimate of its current market cap. I'll just get that up. I should know that. Okay, that's ANZ Bank. Let's try again. ALC is the ticker symbol, Owen. So it's $209 million. The company's been sold down very aggressively. It's down 40% this year, even though, as I'm about to say, it expects to report full year revenue of $34 million, up 31%. And for the year ahead, it has already banked $28 million of revenue in contracts. So it's almost at this year's revenue, which was a record in the year ahead, given the subscriptions. So it's already got 83% of its annual revenue banked, with a further $2.9 million of scheduled renewals. So basically, next year's revenue is basically what it's already recorded this year. So anything that they sell from here on is growth.
And it's kind of common in tech companies over the last 2 years. You know, this company's probably got higher revenue, higher profit. I'm not sure if it's profitable, but definitely higher revenue than it did before the pandemic. Share price probably ran exceptionally, got far ahead, but now it's probably trading at a market cap below what it was, despite it being bigger.
So that I know you don't know the company that well, but you just guessed it. It rose from just before the pandemic at 13 cents to a high of around 44. Now it's back to 16. And in that time, the business, in terms of the fundamentals, has grown considerably. So it's starting to really look interesting too, because it's just gone basically cash flow break even. And so it's scaling revenue, and hopefully operating costs come along with it. Its key focus market is the UK, which is a good one. So it's the way. There are a few ways to measure Alcydian's progress, and probably the most important one, if you're forward looking, is the number of new sales. And they've just come off a record year of new sales, and so they're going to see more of that going forward. So the sales team is established in the UK, in Australia. So it reported positive operating cash flow of $1 million. And I would say it's probably crossed the chasm in terms of product market fit, in terms of scaling now. And I would expect it to be meaningfully profitable over the next few years. So high risk, high reward, small cap company, keep that in mind. Like I just said, it fell from 44 cents back down to like 13 cents. So keep that in mind. That said, I think it's at a really interesting point in its cycle, and I like the business.
How does a company like that pique your interest in the first place?
How do you find it?
Yeah.
Oh, well, I knew a number of other investors that followed it really closely, like Andrew Page from Strawman. But when you screen for companies on the ASX and you go like revenue over X software, there's not many companies in there. There's a lot that don't have revenue. But yeah, if you screen for that, there aren't many companies. Like you've got Alcydian, Promedicus, Nanosonics, Somnomed. I think you got the big ones like ResMed. Can't remember the New Zealand company, but you got a few companies in that mix. You got a few smaller companies that have a bit of a checkered history, and so there are plenty of other businesses in that bucket that aren't on the same trajectory as Alcydian, and it's probably one of the higher quality small caps.
I think it's one of the reasons private equity is so interested in healthcare is because it's not efficient, and this is a company trying to bring efficiency.
Yeah, and actually, so I should say another way that I actually learned about this, probably it reinforced what Andrew had posted many years earlier, was I was asked to do an investment club presentation. It's actually with Angie Ellis.
Yeah.
There you go. And this was at Northern Hospital here in Melbourne.
My wife works there.
Oh, there you go. Jeez. She might have been
I don't
there.
think she attended. Sorry.
Okay. And they have it in the emergency department there. They have a head nurse that's very, very keen on investing and has brought up some really interesting companies. And that day when we were in the hospital, we talked about health tech companies and how that's changing. And it was really interesting to get their feedback on Alcydian, because they're like, yes, we really want this. We love this. But it's probably never going to happen because hospitals move so slow. Yeah. But now that Alcydian is in hospitals, it's a big step in the right direction. So, yeah. We were going to try and be concise, but that's Alcydian.
We'll be quicker with the rest.
Okay, Matt, that's my first one, Alcydian.
I just did the biggest report, the biggest company in the world. It used to be 2 trillion. I think it's fallen, maybe it's still 2 trillion in Aussie dollars, but
Fortescue.
Apple Inc.
Yeah, Apple Inc. I've heard of it.
Yeah, I think it's 2 trillion in Aussie, but it might be under that.
2.66 trillion. That's in US dollars.
Oh, so I was completely wrong. Yeah. That's probably the biggest report and the most important one. It's the biggest holding in all the S&P 500, all the index tracking, all the quality, basically every single index fund you buy. So it's worth looking at. I mean, one of the big takeaways was the fact that it was so resilient. You know, it's still something like 80 billion in US dollar revenue. 40 billion still comes from iPhones, despite the growth in earpods, everything else we have. Or AirPods, not earpods. I sound sounding pretty old now. And even management said it was surprisingly resilient. It seems like phones are becoming a necessity. So people upgrading their phones every 2 years.
Yep.
Maybe it's not 1 year like it used to be, but every 2 years, and happy to pay 13, 14, 1,500 more so, because that's been incredibly sticky. One of the interesting takeaways was this whole supply chain challenge where everyone knows about the lack of semiconductors. They actually said that the production of Mac and iPads, which actually fell, the revenue from those two units fell for the quarter. They weren't actually able to test demand, so they didn't know whether demand for those was slowing because they couldn't get enough supply. So they did have supply chain issues, but I think iPhone sales offset that. I mean, it's just, you look at how amazing the company is, and it's, what is that, 81 billion in revenue a quarter, which is like the size of the Commonwealth Bank's entire market cap.
Yeah, it's crazy. It's bigger than some of the banks,
And then probably the highlight there is that services revenue, so Apple TV,
subscriptions,
all the subscriptions, and they started packaging them all up together, and they're trying
Apple
to learn
One.
more about everyone. That was up 10% for the quarter when everything else was either flat or slightly down.
Yeah. It's the services business is incredibly high margin. I was actually just looking at some news there. On Robinhood, Apple has been taken over as the number one most held stock in the US by Tesla. Probably not surprising. Tesla's a bit of a FOMO stock. But interestingly, there was a news article that I read too that Apple is looking for a senior executive to head up their ad tech business, which is really interesting because
they just cut everyone out of their ads.
They just turn the advertising world upside down. And now they're saying, actually, you know what, we might give this a crack. And I think that's a big thing that's, we see that a lot with Apple. Like I was talking to someone, and we'll get to it in a minute, on PayPal, how PayPal owns Zettle, which is like a seller's business for payments and whatever. And they can do the tap. You tap their phone. Like if you're a seller, I'm a customer, they tap your phone and you can take a payment, but it only works on Android. So it won't work on iOS yet. And so it's like really subtle things where Apple's starting to flex, I think. And this is another example of that too.
Let's say have 60% profit margins essentially in most of their business lines.
Yeah, huge. The one number that you put in, which I thought is probably the most interesting to me, is the installed base. So 1.8 billion in the installed base. They sometimes throw this number around a bit, but it is super, super impressive because that's basically the once you go Mac, you never go back. That's the saying goes.
I've got everything.
Yeah, and you start with one, then you eventually get everything. And that's the stickiness of the software. And the way to measure that is that installed base.
And that's 1.8 billion installed Apple products in the world. So
it's huge.
The population's only...
What,
7 billion?
Yeah, so pretty impressive. And we're about to throw out some big numbers in a minute when we get to Alphabet. So, Apple, rock solid, really strong business.
Yeah, I think the stock's only down something like 10 or 15% from its high, which is incredibly resilient for the biggest company in the world and mid the worst tech sell-off in decades.
Yep. Down 9% this year, but it's rallied recently. So, still up year over year.
Yeah.
Really impressive. Cool. So that's Apple. In at number 2 is a company that reported this morning. So I doubt you've had a chance to look at this one, mate. But it's Block. Trades under the ASX ticker symbol SQ2, like square 2. But on the New York Stock Exchange SQ, which is where it started, I think that ticker symbol may change in time because the company has rebranded as Block. So it's gone from Square to Block. And stock's down 6% today and down 68% year over year. So we've gone from one extreme to the other. Just some quick notes from I think it was the second quarter result. The 3 months ended June 30th, 2022. So $12 billion is what Block now has on its balance sheet in goodwill. The reason is just acquired Afterpay, which we all know. So goodwill goes on the balance sheet along with some debt. That $12 billion of goodwill is up from 500,000. So huge increase. Quarterly, so I saw some reporting, and I still don't know why journalists do this, but they include, you've got to look past, when you look at Block, you've got to look past the Bitcoin revenue, that's like trading revenue, because it's 40% of total revenue, but only 3% of gross profit, because they make next to nothing on it. The subscription revenue is the thing that most people should be targeting. Subscription revenue up 60% quarter over last year's quarter, and it's 60% of gross profit. So that's the best way to measure the
and that's for the Square.
It's like the seller ecosystem. It's for the Cash app. It's for all of that different stuff where subscriptions are. And so $1.46 billion in gross profit, up 28% year over year, but costs up 670 million to 1.68 billion. So that's what gave it the loss. They've obviously got all of Afterpay in the mix now. So
has that goodwill been impaired, or is that?
No, it's just on the balance sheet. I didn't actually look at impairments for that. But I did, however, look at, if I go down a bit, look at the transaction losses and so they call it transaction loan and customer receivable losses. So they recorded, I believe that's 156 million in 3 months of losses. So that's where if they do like buy now, pay later, they do like loans to whoever, and they have to recognize that some way. It's in there. It's down. It's up or down, depending on how you think about it. It's up from $48 million. So this is a big issue in buy now, pay later in Australia with Zip, because Zip's got so many losses mounting up.
They're low margin businesses, so your profit gets wiped out pretty quickly by customer losses.
Huge. And you see this at the first point of the cycle, right? Like you'd think that these types of air quotes loans are the ones that kind of get hit first.
Yeah.
So Bitcoin impairment losses were pretty stable as well. So there's no massive issue there. The thing that I guess spooked the market, other than a slight miss on some notes, the growth that outlook the company had is probably the bit where people were a bit frightened.
Yeah.
They didn't give an exact forecast on the Cash App and how well that's going to grow. Instead, they just said, we expect it to grow, which is not really that promising given, we've got PayPal and all these other players in the market, which we'll get to in a minute. So they said the GPV or gross processing volume through the Square ecosystem was up 18% in July. So another good month, but it was down 25%. So it was growing at 25% in Q2. So meaning that growth is sequentially coming down. And investors did not like that.
That's a bit unique for the US, where a lot of companies in Australia have just stopped giving forecasts in the last 2 years. Yeah. Whereas the US, they still really want forecasts.
Yeah, they love it.
Yeah.
Analysts, like sell-side analysts, because of quarterly reporting in the US, it's a much bigger deal than it is here. We only get it for small companies. So, I mean, overall, if you just look at the subscription side of Square's business, or Block's business, I should say, it's growing pretty strongly. And that's what will lead to riches for people that own this stock. But at the end of the day, they need to contain those losses. And they need to make sure that they're not just continually bloating their income statement. And one way, this is a common criticism of the company, and just this is the last thing I'll say, in the 6 months ended June 30th, 532 mil of stock-based compensation. I think it was, if I'm not mistaken. So that's
just giving out options to retain or attract staff.
Yeah, just crazy. So I think that is something that investors should be mindful of, is how much are these companies giving away, and what do they do with that now that the stock's down? Do engineers still accept that, or do they want cash? That's
take cash.
Take the cash and run. Yeah. So that's the big thing.
It's probably a good thing that's happened in the tech sell-off. Yeah, the stock's down 40, 50%, whatever it is, but it's forcing companies to be a bit more conservative and focus more on cash flow than just outgrowth at all costs.
And that's what we're going to see. Like the cheap money seems to be behind the industry. So at least for now. So yeah, I mean, we'll get to that with some of the companies that we're about to talk about, but a lot of the commentary out of Silicon Valley is that hiring is going to slow. Not be cut completely, but it's just going to slow.
Cheap money, apart from Apple, who raised some ridiculous amount of money at 1% over the treasury rate. So
well, that's huge.
They're a better bet than the Australian government.
But then again, treasury rate's going up.
Yeah.
So something to think about. Cool. So that was Block. Not a bad result. Just investors a bit spooked by that outlook.
Anything tech, you're just going to be incredibly volatile. I don't think that's going to stop until bond yields settle.
Yep. Just strap in for the ride, basically.
Yeah. I took a look at Pinnacle. So Pinnacle is like outsourced marketing and distribution for fund managers, a lot of popular fund managers. So
they take like equity stakes.
Yeah, 40. It's usually 40 to 50%. I think it's less than majority most of the time.
Yeah.
And then the fund manager obviously owns the rest of the company. The highlights there are Antipodes, Jacob Mitchell, you probably interviewed.
Yeah, he's been on the podcast.
The Hyperion guys have had an exceptional run in tech, but are struggling a bit lately. Metrics was the credit group, and then Plato, which I think I mentioned not long ago.
Yep.
Probably the top takeaway, the profit was up, was it 14%? And the company keeps growing at something like 20% over the last decade. But they actually got $600 million in inflows across their stable, which is about 12 or 13 different fund managers. And if you compare that to the likes of, Platinum or Magellan, you're actually in net outflows almost every quarter. So while their assets under management fell from 90 odd billion to 83, most of that was due to market performance. And more people invested more money with them. So it's kind of positive trajectory there. Regardless, it kind of gets caught up in the tech sector and the fund management sector. So the stock's still down 36% year to date, and that's despite revenue going up 40% to 46 million, it looks like, for the year.
It's been an incredible performer. Because they've basically taken the best bits of funds management. Let's just own the equity of some of these funds and let the other people that we get in to partner with, let them take the risk basically of investing well. And we'll just own if they
we'll do the distribution.
Performance and we'll control what we can control and let them do the rest.
And it gives the more diversification than other fund managers that essentially just do global equities. So if global equities are struggling and your performance fees or your management fees are going down, whereas you've got a value manager, you've got a growth manager, you've got smalls, you've got fixed income. So it's almost a diverse investment in a group of fund managers, but the entire sector is under a bit of pressure at the moment. And it's just an asset gathering game essentially, which is raise capital in each of your businesses.
The thing with them, right, like we said they're like 12 or 13, so if one of them falters, that one disappears from the marketing, the next one steps in, and then they just get another one to fill that. And the Pinnacle brand probably isn't damaged as much. So it's asymmetric in terms of their business model. But the valuation on this thing sometimes goes to exorbitant levels. Like it's crazy.
I think there's a momentum challenge there because it falls into tech and it falls into funds management. And then if it's growing at 20% a year, assets under management, and obviously fees go up with assets under management, people want to value it like a tech company. But you can see it constantly get overvalued and get undervalued just as quickly.
So let's just wrap some context around this. It went from $4 in July 2020 to a peak of around $18.60 in November 2021. Fell recently to $6.80, and now it's back up to $10.90.
It's almost, if you watched the 2020 to 2021, it's almost all because of related to Hyperion, you'd think, because Hyperion was one of the best performing managers in the pandemic. And has struggled since in 2022. I think if you did
if you just looked at the performance of that,
I think it'd be very close.
It's like one of those chart crimes where you just overlay something random with, and look at this.
Causation or correlation.
That's it. But so that's Pinnacle, PNI on the ASX. Really interesting funds management business. If you can pick it up cheap, it's growing very well. I think the founder's still at the helm. So really interesting business. So the next one that I've got on my list is PlaySide Studios. It reported quarterly recently, and as usual, PlaySide came out and reported a bunch of commentary with it, which helps. I think the highlight for me, just if I could jump to that, is the thing that I was really worried about is this is the company, I don't know if you know it, Drew, but it actually...
not gambling. Normal gaming,
Normal gaming, normal gaming. But actually, think of gambling. It did actually launch some of its own NFTs, and it made quite a few $1 million out of that. And the thing that I'm going to take away from this quarter is that this is the fourth quarter, 2022, I think it was, FY22. It produced $5.3 million of cash receipts, or thereabouts. Net operating cash flows, so before we get to investing cash flows, negative $37,000. The reason why I say that I'm happy with that is because I thought that it would be negative because they've hired so many software engineers and developers and artists and whatever. But if we include investing cash outflows, which is where it invests in intangible property like intellectual property for its games, and $210,000 of PPE, it's a $2 million outflow for the quarter. Fortunately, the company ended with, and I'll get the number up.
$37 million.
$37 million in cash. And that's because it's done a great job of selling. It IPO'd not too long ago. It also did that Beans NFT raising, which is basically like 100% margin. And with the Beans NFTs, I'm a happy owner of one of those. Well, I shouldn't say happy. I'm down about 95%. But I'm an owner of one. And they earn a clip every time that is then traded in the secondary market on OpenSea. So they just keep receiving like an annuity, even if it's, I think it's about 6%. I could be wrong, but they just earn that. But so anyway, what does PlaySide do? traditionally, PlaySide, started by Jerry Sackers here in Australia. He's from Melbourne. They've got a studio on the Gold Coast, big office here in Melbourne. They make games, mobile, PC, console. They started predominantly in mobile, and they've built it out from there. Some of their big brands include Animal Warfare, which is just a game where you got animals and they fight. It's a whole thing. They make ad revenue, and they can do premium offerings where people play for games and they get listed on Steam and you download them and whatever. Two things that they announced recently. One was PlaySide Publishing, which is where they go from just making games to supporting other games like indie games and whatever. And they're going to focus on PC and console for that. And the reason that they can finally do this is that, one, they've got heaps of experience in developing games. They've got over 100 employees now. But two, they made a number of really big hires from like Team 17, Activision, Blizzard, Bethesda Studios, which makes my favorite console game, which is Fallout. And so they've got all these people that know how to publish games, finally, so they'll do it. Yeah. Does it add risk? Maybe a little bit of risk. Revenue for the quarter, 6.08 million, up 94%. As I said, cash generated, 5.4 million, up 49%. Cash position, 38 million. FY revenue is expected to be 29 million, up 169%. Work for hire, which is where they work for Meta or Facebook or do some games for them. They've got a backlog of that, 15.6 million. The thing to watch going forward with this company is the launch of Godfather and Legally Blonde, two big games, as well as the Dumb Ways to Die franchise. Dumb Ways to Die, by the way, Drew.
Mikey?
Yeah. On the trams and trains here in Melbourne, they bought that brand. That was about 8 years old when they bought it. They bought it for, I can't remember, but it was $1 or $2 million. They sold the NFTs for, I think, 8 million off the top of my head. So
good timing.
They've done very well out of it. So this is with Jerry and the team, the things that I love are when they launch games, they do so much testing. Like Legally Blonde and Godfather are already being tested and they're tweaking the games depending on like marketing and whatever. But what they do, for example, is they buy Google ads on the brands and Facebook ads before they actually go and tender for the intellectual property. So they know which one's going to be received well before they even bid. And so every part of the way they're testing. The three keys looking forward are hiring costs. How does the company go with managing its huge staff load? And original IP. So that's where they develop their own games, Legally Blonde, Godfather, etc. They also need to keep winning work for hire, in my opinion. Work for hire is like contracted work that they do for all the big ones.
Yeah.
And the final thing, and this is the thing that's going to scare a lot of people, I think, is shares from the founders are coming out of escrow in December.
Yep.
And there are a lot. And so will some of the shares be sold? Maybe. Something to be mindful of.
How's the share price sitting?
Well, the share price...
If it's down too far, they probably won't sell.
Hit a top of 125 not too long ago. It's down to a recent low of 55 cents.
Yeah.
So, yeah, keep an eye on that, basically, going forward. It's going to be a good annual result, and I'm keen to see what they make of it going forward.
That'd be a potential takeover for someone when EA wasn't merging.
Yeah, Microsoft and, Microsoft's making a big foray into the sector. Facebook loves its games.
Yeah.
All of the way entertainment is transitioning, like the metaverse, they're doing Web3 stuff.
Yeah.
So the way that's all going now is they need creative and they need developers.
Yeah.
And this company is probably Australia's leading, at least listed on the stock market, game developer. So interesting times. But the founders control a lot, so if they don't want to sell, it's not going to happen.
Yeah.
Yeah. Cool. That's my number 3.
The silver donut. I think that's what they call it, don't they?
Yeah.
I skipped lunch too, so I shouldn't say donut. So record profit up 56% to 4.7 billion.
Yep.
I think it's probably got one of the best CEOs in Australia.
Yep.
I'll say Shamara. I can't say.
Yeah, I can't pronounce the surname, sorry.
Embarrassed myself doing that. There's, I think, 4 main business units, and all of them were performing well at the same time. So asset management, which does all kinds of issues Macquarie funds or invest money for institutions, banking and deposits. So I do my banking, got my mortgage at Macquarie. Macquarie Capital, so that's the one that's doing all IPOs, mergers,
capital markets,
placements,
yep.
And then capital markets and energy markets, where they basically help institutions put hedges in place or put trades for things like oil prices, energy prices, and they also
all that stuff you learn at uni.
Yeah, exactly. And then completely went in one side, straight out the other.
Yep.
There was amazing. I think it must be Morgan Stanley came out and said they've got the world's biggest green capabilities as an infrastructure company, which is incredible given they've always managed infrastructure, invested on their own balance sheet, started sharing it with institutions, and now they're leading the world in financing and building renewable energy assets everywhere, Europe, US, Australia. And that's been probably the most surprising.
Hey, can I just totally take this in a different direction? Was it Macquarie that had that index option thing that you were talking about?
You mean True
Index?
True, I think it's Macquarie True Index, yeah.
Yeah. So that's where you can track the index.
For free.
For free.
Yeah.
Yeah, right. Anyway, just thought I'd bring that up. Don't know, just random thought. Okay.
They're an investment bank. So investment banks just try to make money wherever they can. It's very simple. That's why they call it the millionaire factory. Yeah. There's a product that they can make. They're obviously upfront in fees. They'll do it. And then, the year shows that every part of their business was up. But interestingly, the CEO was very negative in this. I think it's good management when you say, what's the old saying? Under promise and over deliver. Yep. So she's basically said every division performed well this year. We don't expect any of them to perform this well next year.
Yep.
Maybe that's why the share price is kind of floating, I think about 170 from memory.
Yeah, 176.
I think it peaked somewhere over 220 at one point last year. But the highlights there, when I refinanced there, it was the easiest process I've ever had in opening a loan with a bank.
Really? What'd you do?
Like it was everything was DocuSign, cards were issued. I never had to enter, they don't have branches. I never had to enter a branch, did everything online. Once it was approved, it was incredibly simple. Great app.
Yeah.
And you look at someone like ANZ who's struggling to make loans in the last 6 months and buying someone else to do it. So their deposits were up. So term deposit rates are increasing. They're up 9%. Yeah, 3.5% or something for a year.
Yep.
And then the home loans were up by 8% too. So they're picking up their market share that groups like ANZ and the smaller banks have been losing. And then, they manage $770 billion in the asset management division and have a heap of capital to deploy. It is very cyclical though. So they have to realise and sell businesses and assets or do IPOs. We won't talk about the Nuix one. That one still annoys me. They have to realise those to get big chunky performance fees that come out of the back. But it's just a behemoth, well-managed and profit machine.
Yeah, I remember during the GFC, it went from $90 down to like 16 in the depths. So got absolutely crunched. One thing that they did basically as a result of that is they shifted away from the capital markets focus.
Yep.
And they moved into mortgages. They moved into banking, that kind of like mortals could get into and things like that. Then during the GFC, they fell from $144 down to $80, just like a click of the fingers.
That's when we bought it this time.
Oh, really?
Yeah.
Yeah, right. And then now it's back up to 175. Fascinating business. It's like 50 plus years of profits.
Unbroken profit somehow.
Yeah.
Sure.
Accounting for changes, that's fine. And the thing is they pay a good not fully franked, but partially franked dividend as well.
Yeah, definitely.
So really interesting business. Like it. We need to get the CEO on the podcast. What
great.
can we do? How do we get her on? She's got other things to do. Okay, so my next company, I'll be quick, is PayPal. I covered this briefly on Twitter earlier this week, just mentioned it. PayPal, global payments juggernaut. The big thrust for PayPal is basically where does it sit in a world with Block on one side trying to gobble up sellers and more innovative payment providers, and on the other side with Apple and Google, Samsung, all these Alibaba, all those. How does it sit between all them? As many of you may know, that PayPal was bought. It was started by Elon Musk. Oh, no, it wasn't started by Elon Musk, but Elon Musk sold into it and blah, blah, blah. PayPal Mafia, Peter Thiel, Max Levchin, all those guys. It was bought by eBay. eBay spun it out, I think, around 2014. eBay is now dwarfed by PayPal. And the eBay revenues, because PayPal used to be the gateway for eBay sales, it's now rolling off. So they're trying to adjust results accordingly. During the quarter, it was a pretty strong quarter. I think for the most part, investors were really impressed. So it beat expectations. It's going to do a $15 billion buyback. There was one interesting thing, which is last year, PayPal was rumored to be going to buy out Pinterest, which is like the social media image sharing platform. But what actually transpired is they said no in the end, which would have been a good deal for Pinterest. But basically, there's an investor on the PayPal share registry called Elliott Management. And they seem to be, I don't know much about them, but just reading about them seem to be more active and vocal. They also have a big stake in Pinterest and PayPal.
They did BHP, I think they...
Oh, did they? Yeah,
a few
right.
years ago. Yeah.
And it's really interesting around that. They said they're doing an information sharing, like a partnership with PayPal or something like this. So that's interesting. In terms of earnings per share of 93 cents versus the analyst estimates of 86. Revenue, 6.81 billion versus analyst estimates of 6.79. So just a slight beat there. PayPal had, and this is where it impressed me, 429 million active users, which was up 6%. So that was slightly behind consensus of 432, but it was overall pretty strong considering it's been a few slow years. PayPal's dropped its target of, I think it was 700 million users or something. And engagement was up on the platform. So more people using it.
I feel like the opportunity's got to be in emerging markets still, doesn't it? With something like PayPal where we don't necessarily use them as much in Australia.
Yeah.
Smaller websites.
So in different markets, like, there's a leapfrog effect where, so like Alibaba, they went straight from like cash to mobile.
Yeah.
Whereas we went to Visa, Tap and Go, electronic. And Mercado Libre in Latin America is very powerful.
Yeah.
And they did have a cross shareholding there for a little while. So they're another one to be mindful of. But for the most part, this is a interesting thing because the CEO came out and said, we've got too many heads. We could be more efficient. So this is probably one of the companies that is saying, no, we're actually going to cut or we're going to reduce headcount. So that for a hugely profitable business, really interesting. They're exploring ways to integrate PayPal with Venmo. So Venmo's their peer-to-peer payment product, like the Cash App.
Yep.
Zero fee to transfer between friends and whatever and split bills. So that's, really interesting. It was probably more robust than people expected, and that's why shares are up. So that's PayPal.
Another great company that's been sold off heavily.
Huge, massively. So,
determining whether it's cyclical or secular.
Yeah, I think there's a lot of tailwinds at its back, but also competitive threats are now becoming a thing. So down from over $300 a share to a current $96. So big way down.
I was scraping the barrel. No offense.
Here we go.
A listed investment company.
Okay.
Which it's kind of, this will be a very quick one.
Okay.
I just said it was a weird one to review. Basically, Australian Foundation, AFIC, AFI, holds a portfolio of Australian listed shares. They can't turn over a lot because they've been holding Aussie shares for a long time. There's a lot of capital gains. So there's always this risk that, there's transaction costs that come.
Yep.
With selling them down, and obviously it's a company structure, so they pay tax. That gives them the benefit, which is to be able to, if you're buying a share directly, you only get the dividend that they pay that year. So in the pandemic, it dropped 50%, but I'm pretty sure from memory, AFIC didn't drop their dividend. They actually held it still because they had a build up. They basically carry cash. They got 114 million in cash at the moment, and they've got a franked credit reserve, so they can keep paying fully franked dividends as a company without the same dividends being received by the company on the other end as revenue. So their profit was up 53% to 360 million, and revenue was up 50% to 393 million, which tells you they don't have a lot of costs. Their only costs are, I guess, custody, accounting, and investment management fees. They say it's a low MER, so management fee, it must be something like 20 million they pay to their staff to manage the portfolio, and that's 0.16. So that's almost equivalent to IVV or someone else.
It's super low.
Obviously, it can't change all that much. Probably the interesting takeaway there was that they said they were paying about 10 cents of the dividend from capital gains, either realised on their portfolio of stocks, whereas historically it's all been from retained profits and fully franked dividends.
Yeah. Okay. That's interesting. So forgive me if I'm wrong. We probably wanted to see more of the income paying
all
out.
the frank, which could just be a combination that dividends aren't quite back to where they were the year before, and maybe they don't want to run down the franking credit balance. So if you're paying capital gains, you're likely to not have as many franking credits on that, but depends how it's structured.
So I get a lot of questions about this. AFIC is one of those unique listed investment companies that offers a DSSP, rather than a DRP. I don't know if any of your clients have one of these, but so basically, instead of a DRP, dividend reinvestment plan, where you get the dividend paid out in new shares, and you still have to pay tax on that dividend, even though you don't receive it in cash. A DSSP, you don't get the franking credit and all that sort of stuff, that benefit. But what actually, you get the new shares, but you don't get taxed on it, but it comes out of your cost base in the long term.
Yep.
So the difference is you're basically substituting tax now for tax in the future.
Yep.
So that's a DSSP. If you want to Google it, just Google
Deferred.
AFI DSSP. It's on their website and it explains more. So
Yep.
that's what the tax, franking credits, DSSP, all this stuff makes AFIC a pretty popular one for people that are tax conscious.
Yeah, definitely. Yeah. And aren't comfortable with the volatility in income that comes with holding direct stocks as well.
Yeah. Okay, so my lucky number 5 is Alphabet/Google. Alphabet obviously is the global search engine business, so it owns Google, which owns everything. So,
it's listening right now. So
it's listening. Yeah, it probably is, to be honest. I know Apple's listening. If I was to say, "Hey Siri," so revenue up 14%, $69 billion, lapping the strong performance last year. So it's a bit of a slower period. It will also take a more considered approach to hiring. It hired 10,000 people during the quarter, mostly in technical roles like software engineering, and it expects that, I believe, to decline. So the search business is incredibly dominant because of ads. But this is the thing. Google has continued to win despite Apple privacy changes, and Google pays Apple billions of dollars a year to be the default search engine inside Safari. I don't have anything on this. I don't know anyone that works at either company, but I suspect over time Apple is going to try and strong arm Google.
Like they did with Maps?
Yeah, exactly like Maps. Like the new Apple Maps is, now I can finally say this is better than Google Maps.
Yeah.
Maybe except for like the reviews and that. I think they still use like Yelp or something. I don't know. It's like bizarre.
They're a bit more resilient in terms of advertising, weren't they, than a lot of than say Facebook and some of the other streaming.
And that's because of the IDFA changes basically meant that so the way they track you through like your IP on your address on your phone or your whatever you use, Google is more based on search intent. So, holiday, Italy, hotel options, right? And then it pops up. Whereas say Facebook's like you look at a picture and then tracks you through and it shows you pictures of holidays and destinations. Whereas Alphabet and Google, it's got billions of signed in users who can automatically, it knows based on what you're searching, what you want.
Yep.
And that's a big difference than using your personal identifiable information.
Yeah.
So still very dominant is search, 58% of all revenue, $12.5 billion of free cash flow in the quarter. Unbelievable. The thing that got me is YouTube advertising, not that strong as usual, up 5%. The thing that
we haven't been doing enough podcasts for.
We have not. We have to lift our game, mate. So So the thing that really got me is inside Google. I don't know. Have you ever looked at these? You're on one. I know because YouTube Shorts. Have you seen that?
No.
So this is like a short form version of TikTok inside the YouTube app. So when you click on the YouTube app, no matter what device you're using, there'll be like the home button. Then there'll be Shorts. Looks like an S. Then there's like library and my account and whatever on the menu. And now my thing automatically opens to Shorts. And Shorts are videos that are instead of being like horizontal, they're vertical on your screen. And you flick up and you continuously keep going through like TikTok, right?
Yeah. I don't have TikTok, so.
Okay. So for those,
Reels.
many of us that don't have TikTok. But the thing is, everyone's been worried about TikTok. TikTok, if you look at the growth in users, it's been the fastest ever growing social media network. And Facebook's been hit by it because Facebook's got a younger person problem. And YouTube has this. YouTube currently has over 2 billion logged in users every month on the platform. It's now watched by 1.5 billion signed in users on Shorts alone, right, every month. 50% of ad-supported US streaming from 18 years old and up is on YouTube alone in the US.
Watching TV or watching YouTube
watching
instead of TV.
YouTube, instead of TV. 5 million subscribers now on the YouTube TV, but that includes trialers, so people that pay for that.
Yeah.
And they've just announced a partnership with Shopify where you can do shopping inside of YouTube or like a partnership there. If we jump across the hallway and we go to the Google Cloud business, was up 36%. GCP, which is their cloud compute, and Workspace, which is like all the tools that I use. I think you guys use Microsoft. Yeah. Same. Lots of growth, new partners from Target. There were a bunch of US states, so it'd be like the state of Victoria using GCP for its cloud computing. If we go across the hallway again to the Other Bets division, which is like where they take stupendous amounts of money and invest in these new age technologies. Some of them don't pay off. The one that everyone watches is Waymo, the self-driving company. It is now running fully autonomous ride sharing in multiple locations at one time. So really impressive. They've got this business called Wing, which is like drones. It's like Amazon. Everyone's trying to do this, where it's drones that deliver your parcels. In the first quarter, so this was the first quarter results, in particular, not so much this one, 50,000 commercial deliveries. So that was up 3 times year over year. 3 billion users on Android every month. Over the past 2 years, they've invested $40 billion in cloud and AI. $124 billion of cash. So
it's bigger than how big is BHP? 120 billion.
Yeah, they're just taking BHP and put it into the business. So I'm just going to pull out 2 quotes just to give you a flavour of what everyone's thinking at the moment. This is a quote. In travel, users' appetite continued to remain strong heading into the summer season. Searches for, quote, places to visit in summer, quote, were up 2 times globally year over year, while searches for, quote, last-minute hotel deals were up 50%. And there's another quote. In the second quarter, searches for, quote, open now near me were up 8 times globally year over year, while searches for a designer outlet jumped 90%. So this is all pointing to very, very strong, which is what we already know, very, very strong travel and people doing things out of the home. Restaurants, cafes, bars, nightlife. Everything is coming back in a very big way.
Bodes well for advertising as well, doesn't it?
Advertising for basically every business that's physical is all of a sudden now in demand, which we know. Yeah. Skills shortages in those areas too. So the only blemish on the update was the somewhat cautious outlook with the uncertainty in ad spending. So, they're going to slow hiring as well. This business is going to be leaner.
Yeah.
I know I spent a bloody long time on that, but it's really interesting.
I think it just kind of shows the importance of having global companies, doesn't it? If a company's got 120 billion in cash on the balance sheet, I'm sure the PE on it isn't ridiculous either. Maybe
you'd adjust out the cash too with the PE. So
yeah, it just shows like a lot of us have a home bias and like to buy Australian stocks, but there's just so much quality overseas and size.
23 times price earnings multiple. If you took out the cash, I mean, it'd be a bit less than that. So it's pretty cheap when you compare it to Woolies. It's got Woolworths is 29 times PE. Yeah, I know which one I'd take.
The last one, sticking with the US, because that's where all the action was last week, Amazon, which I think everyone knows they build for scale, so they don't necessarily look to make a profit every quarter, but they accidentally made a profit, I guess. $3 billion in profit. They were expecting $1 billion loss. They've been hit lately because they invested in Rivian, which is like the new version of Tesla. I think a few companies did, and this is quite common in the biggest tech companies. They try to find growth by having strategic stakes in fast-growing other companies. Mm-hmm. But their sales were high. I think the stock went up about 10 or 11% on the day they reported.
Yeah, it jumped really heavily,
Sales were up 7%, apparently excluding currency because the US dollar has been so strong. It would have been 10% growth. So still pretty solid for such a massive global company. Cloud slowed. I'll use the quote marks. Up 33% for the quarter. So that's 20 billion of their revenue now comes from cloud computing. So Amazon Web Services, same thing you were saying before.
Yep.
Advertising, I assume that goes across all their businesses. So Hulu and even their ads running on their Amazon sites. So that was up 18%. Online sales were 4%, so slightly flat, which kind of tells you more people looking at services and travel rather than buying goods on Amazon still.
Yep.
I mean, one of the amazing things is they say they're going to do 60 billion in CapEx in the next 12 months. So like they're spending the market cap of some of Australia's largest businesses every year in capital expenditure to help improve themselves as compared to companies in Australia that pay out 80% of their profit in dividends. So,
did I hear that they did 100,000 in layoffs?
That was my first point. I was going to keep that to the end.
Oh shit! Sorry.
Yeah, I mean, it just tells you, I think they're one of the biggest employers in the world. So
Yeah.
it sounds like a lot
Millions.
to us.
Yeah.
But I think it's just a trend where there was almost competition. Yeah, almost had to get ahead of what was happening in parts of the technology sector.
Yeah.
Hired more people than you needed to.
And in fulfillment too, right? Like in the factories and warehouses and whatever.
And that's probably the biggest quote. So the CEO isn't Jeff Bezos, it's Andy Jassy. And he was saying that they've actually, after, all kinds of costs getting out of control, whether it was COVID screens and tests and all those sort of things, they're well back under control. And the productivity of our fulfillment network, probably Amazon Flex and using more casual workers, is significantly improving, which is key to having profit margin and eventually becoming a more profitable company if they ever want to.
Yeah.
I mean, I think investors be happy to back them
Continually.
regardless of whether they're going to seek to pay profits and dividends.
Yeah. The Rivian, I was just looking at Rivian. So Rivian Automotive, it IPO'd, I think off the top of my head, about $100 billion valuation.
Top of the market.
Bugger all
completely,
in revenue. And
cool looking cars.
$55 million in revenue, says Google. This is just off the top of my head. Now it's $32 billion.
Yeah.
So it's like $70 billion of investor capital is just up in smoke. So it's easy to see why they would adjust that on their income statement.
And they lost $44 billion on it. Yeah. Just in the last quarter. I think they obviously mark it down as it goes down.
Yeah. So that's incredible. So the Amazon actually is, in my opinion, a really interesting competitor in ad tech as well. So they have a lot of supply for their own ads, but they also have demand side as well. So they, if you think about it, particularly in the US, not so much here in Australia, although I think this is going to happen, is a lot of people at the moment still go into Google and type in tracksuit pants or whatever.
Yeah.
Pellegrino bottled water, right? But for most people, Amazon, because they have the loyalty program, you don't go anywhere else. You just go straight to Amazon.
Yeah.
Like I did that the other day. I didn't bother to search anywhere else for tracky pants. I just went straight to Amazon. And this is the thing, right? I got my
Chinos.
Mate, this was at home, so I'm allowed to be a bit more casual. But I got my champion, legit, they were champion pants. Got my tracky pants, and they were $33 on Amazon. I walked into JD.com, it's like an in-store thing. It was $69.99.
Yeah.
And I was like, well,
it's price transparency.
yeah, chalk and cheese. I just go online. It was, incredible.
They're getting good TV shows too. They're building that ecosystem around it.
The Prime. Yeah, I don't know have you seen The Night Manager? It's an older one. I went back and watched it again.
Yeah.
It's with Tom Hiddleston.
Yeah.
It's really good quality.
Exceptional. Yeah.
I like it. There's some really good ones on there. The new one with Chris Pratt as well. So many good recs. Anyway, so that's it for this week. We've got through 10 companies. Just a lot of companies. Probably why don't you think of the highlight for you? For the highlight for me, it's probably Alcydian being small cap. But even PayPal's result was very strong, far stronger than I expected. So I don't know. What are you going to go with? AFIC?
I'd say Apple.
Okay,
Nice try.
Okay.
There's a lot of A's in that one too. Yeah.
Yeah, you did. Yeah, you got Apple, Alphabet, AFIC. Jeez, yeah, okay, we're going on it. And Alcydian. Next week, we're going to come back with 10 more. And so if you do want to hear us quite quickly and concisely, hopefully, cover 10 companies, let us know. We've got a lot more Aussie companies next week, just because of the sheer number of companies reporting. And the week after that, even more. The page goes on. And the final week of August will be when we can find some hairy ones.
That's when the naughty companies.
That's when they come out and they're like, okay, no one can see us now. Everyone's tired. So we'll come out with our result now. But yeah, if you want us to cover one of those companies, send us an email, podcast@rask.com.au. Hit us up on socials. You'll find Drew at wattlepartners.com.au, financial planner based here in Melbourne. Although, do you service customers or clients from other cities?
Everywhere, basically in every city, every quarter.
Yeah, right. Okay. So
every
city,
major
every
city,
quarter.
not every quarter,
That's a good way to phrase it. Okay, great. Well, Drew Meredith, thanks for joining me.
Thanks again.